Good morning and welcome to the I3 webinar, Emerging Markets Through the Factor Lens, co-hosted with Northern Trust Asset Management. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. So in this industry, we always warn that past performance is no guarantee for future performance, and for good reason. But when we say this, we often meant it to mean that good performance in the past might not continue into the future. Opposite is true as well, of course. Disappointing performance in the past might not continue into the future as well. And so our speaker today will make this case for emerging markets. In this webinar, we will be discussing the reasons why the performance for emerging markets has been somewhat disappointing in recent years and why this might change going forward. We will also look at how a multi-factor approach might help in capitalizing on opportunities in emerging markets. So our speaker today is Michael Hunstead, who is Deputy Chief Investment Officer and Chief Investment Officer for Global Equities at Northern Trust Asset Management. He is a member of the Asset Management Executive Group and has oversight over all equity portfolio management, research and trading activities, including quantitative, index and tax advantage strategies. Now, we had some issues with Michael's camera before, so he will be on audio only, but he will share some slides with us. We would like to make this webinar as interactive as we can, so please feel free to ask us plenty of questions through the question box, and we'll try to cover as many as we can. Also, as a disclosure, we do have to mention that this webinar is for educational purposes only. It does not constitute financial advice. It is intended for institutional and wholesale investors only. All right, Michael, over to you.
Great, thank you, Wouter, and thank you everyone for participating today. If we can advance to slide 2, this just gives us a snapshot of global equity performance year to date. And what a year it has been. If you look at some of the numbers in the developed markets, that's sort of the top of that box toward the bottom. Obviously, you know this already, but double digits more or less across the board. Developed market really led by the U.S., delivering 18% returns year to date. That's in U.S. dollar terms. Where emerging markets, you can see, is literally and figuratively sort of all over the map. Currently, we're up about 12% year to date in emerging markets. Again, that's in U.S. dollar terms, but a 6% difference to developed markets. That was actually at parity earlier this month. So yeah, it's crazy how fast this can change. Now, obviously, China is a big piece of that. And clearly, we saw some stimulative measures that have come out of China that have played havoc with this gap. Just to give you a sense, China was up year to date as of 9/11. So the September 11th was up only 0.7%, so barely positive. That went up to 46% return as of the 7th of this month. Now that has come back down, obviously, to about 23. But this sort of harkens back to the earlier part of the century when EM typically significantly outpaced developed markets. Now, a lesson here clearly is there is a lot of volatility in the EM space today. It's getting successively a smaller portion of ACWI benchmarks as developed markets tend to outperform emerging markets. So a lot of our clients these days asking the question, what is the investment thesis for emerging markets today? And I want to talk about emerging markets overall, but more, importantly, how we think about a factor orientation within EM, within the emerging markets, because I think that has a tremendous amount to offer as well. So if we can go to slide 3, we'll start off with just the highest level. And, probably no surprise, but emerging markets look very attractive on a valuation and really a fundamental basis as well. Left-hand side of the page, we have the price-to-book ratio going back to the early 2000s. You can see that gap we have today is as big, if not bigger, than we've experienced in this history. Kind of similar to the early 2000s, developed markets, more expensive at the time, but strong performance and growth from emerging markets really narrowed that gap. And from a fundamental perspective, on the right-hand side, when you look at analyst consensus expectations globally just 14.4% earnings growth expectation. For emerging markets, 17.6%. And for some specific markets like Korea and Taiwan, very, very healthy growth expectations. So valuations look very attractive. Fundamentals, earnings growth expectations look very attractive. So from a fundamental valuation perspective, a good opportunity. And this is why we at Northern Trust have a tactical overweight to emerging markets as a result. Okay, so probably no shock here, but by and large, we see as good, if not better, fundamentals growth expectations from EM as we do DM. Okay, but why then, if we go to slide 4, do we have this interesting phenomenon that really over the last decade, emerging markets have generally underperformed developed markets? So on the left-hand side, there's a lot of lines here, but what are important are the gray bars. And these are the excess returns of emerging markets versus developed markets. You can see they've been below the line for much of the last decade. So how can that possibly be the case? Given that in general, the thesis for investing in emerging markets is that you want to harness the GDP growth, which has generally been healthy in the emerging market space, but it has not materialized into actual performance. Now, to really decompose that, and I think one of the more important graphs of this entire presentation is on the right-hand side. So what we show here is the decomposition of returns over the last decade into pieces. Dark green is revenue, sort of the blue is dividend yield. We also have the lighter green is profit margins, valuations, which contribute very, very little in the emerging market space, in contrast sharply to developed markets. But then in gray, and oh so important, is share issuance. So when you think about a company, you as a shareholder earn the return of a stock, but only to the extent that it's not diluted away by issuing additional shares. And you can see for many emerging markets, in particular China, a negative 10.9%, that's the gray bar below the line, there has been a significant degradation in performance of these countries' equity markets because of rampant share issuance. So just to give you a context. So when I look at China over the last decade, total performance, roughly 2%, but fully 1,000 basis points, 10.9%. So more than 1,000 basis points per year drain of performance due to share issuance. Now, in general, revenues were healthy, profit margin expansion was positive, valuations didn't play a major role. All in all, things look pretty good. But you can see the difference between sort of where that top above the line bar, green bar, measures out versus below the line, and then finally that diamond kind of right at zero, if you will, that suggests that the realized return from this benchmark, from this country was significantly impacted. Now, go a couple bars to the right to India. A large amount of share issuance here as well, but they have the revenue growth, the earnings growth to actually back this up. So 11.6% return for India, despite the fact that an 850 basis point, 8.5% drain per year due to share issuance. All right, so the building blocks, when we look at it this way, kind of make sense from a revenue perspective, that revenue growth has generally been quite strong, but it's been that share issuance that has been a major drain, one of the reasons for the major drain on performance over the last decade. Okay, so the question is, what can we do about that? We like the idea of investing in emerging markets for their valuation, for their earnings growth, but can we do something to combat this drain that we see from share issuance? Well, if we can go to the next slide, slide 5, we can see that one of the tactics to utilize in the emerging market space is not simply investing in the core benchmark, but investing in style factors within that emerging market benchmark. And to illustrate not only the performance, but also the persistence of factor returns, on the left-hand side, what we show is the Q1 minus Q5, so the long-short performance of individual factors since 2000 in the emerging market space. And they're all very healthy, right around 8, 9, 10%. So if you were for example, a momentum investor, you earned a long-short implementation of about 10.9% return. Low volatility was a little bit less. Quality was about 9%. A multi-factor, so a little bit of everything implementation, that green bar on the right, about a 10.6% return. So that's, again, long-short. You don't necessarily always realize that in a long-only context, but it shows that there is potency over the last 24 years, 25 years to EM factor investing. Now, right-hand side, we shift to the decade in which, in general, emerging markets underperform developed markets. And while these bars aren't quite as high, they're still very material in the sense that we can extract factor premia over the last decade, and emerging market strategies certainly have been potent in their ability to deliver factor returns. But this just shows that even over the last decade, where the performance of EM versus developed markets was challenged, that factors actually delivered on their promise of excess return. So a great opportunity in the emerging market space to capitalize on factor performance. But if we go to the next slide, slide 6, I just want to show you the relative performance of emerging market factors versus developed markets, ex-US as well as US. And just to highlight, so the gold bars are emerging markets. Obviously, gray is US, green in the middle is developed market, ex-US. There is potency really across the board, and EM is very much in the mix. It is not a situation that factor performance is localized to any one market. Now, there are differences, of course, across markets in terms of their factor performance. Not really statistically significant in most senses, but really across the board, as we look at quality, value, size, momentum, low volatility, they have been additive to performance in EM, really no less than we see in developed markets as well. All right. If we go to slide 7, this just highlights the correlations between markets. And what this shows you is that when we look at monthly correlations in dark green between emerging and developed market factor exposures, or annual correlations in sort of the lighter blue, these numbers are positive, as you would expect, but significantly less than 1. So what does this mean? So if I have a correlation of, let's say, value of 0.5 between emerging markets and developed markets on a monthly basis, this means that there's some similarity between value performance between EM and DM space, but the correlation is relatively low. What does that mean? That means diversification. And across the board, you see momentum 0.37, dividend yield 0.46, quality 0.38. What does this mean? This means that if you are a factor investor in both developed and emerging markets, these are great complements to each other. Because these correlations are far less than 1, there is great diversification for being a factor investor in both DM and EM space. They're all positive, as we might expect. There's some similarity in factor cycles, but they're all far from 1, meaning there is a strong benefit for being a factor investor in both geographies. Okay, it doesn't stop there, though. If we go to the next slide, slide 8, this shows diversification or correlations within markets. So if I look at pairwise correlation between countries in developed markets versus between countries in emerging markets, on the left-hand side, those bars for EM are very, very low, almost close to 0. What this means is that when we look across countries So quality within India versus quality within China has a very, very low correlation. And in general, in the emerging market space, those pairwise correlations between countries significantly lower than developed markets. Again, a great reason to be a factor investor in the EM space. You get added diversification at the country level. And then if you look at the right-hand side, this just shows the percentage of variation. The first principal component, if we look at EM and DM independently, you can see that lower numbers for EM, meaning that there's a lower explained variance for that first principal component. Similar kind of story. This just again suggests that there is a lot of cross-country diversification in the EM space that we can capitalize on. Okay. Now, when we think about EM factor implementation, the most important thing that I can leave you with today, and I'll go to slide 9, the next slide, to really highlight this, is that design matters. When we think about implementing a factor strategy within emerging markets, you have to be even more careful than you are in developed markets. And just a few pieces of information on that. Upper left-hand side, this is the Herfindahl-Hirschman Index. You can see the relative values between EM and developed markets. People talk a lot about developed markets becoming more concentrated, and they certainly have. But emerging markets have always been concentrated. Have actually become somewhat less concentrated since 2020 as names like Alibaba and Tencent tended to come off of their highs. But this actually creates a really important consideration when you think about active risk-taking in any market, but especially in EM, in that you have to be careful that idiosyncratic risk doesn't dominate your portfolio. Now, in a concentrated market, if you're going to take an active position, typically what you do is underweight the largest stocks. And because emerging markets have such a high level of concentration, virtually everyone is underweighting and underweighting significantly the largest of the large names. As a result of that, that introduces a tremendous amount of idiosyncratic risk into the portfolio, not because of what you own, but because of what you don't own. That's a really, really important consideration. Off to the right-hand side, when you think about a capitalization-weighted benchmark, you often think of it as being style neutral. In the developed markets, those are those two kind of faint dotted lines. That actually tends to be the case. Things like beta and momentum are relatively consistent, but not so in emerging markets. When you look at beta and momentum relative to their long-term averages, they're kind of all over the place. So when you're forming a portfolio, you have to be keenly aware of the fact that the underlying benchmark may have style exposure associated with it, and this has to be taken into account in your portfolio construction process. The last thing I'll say on the slide, bottom charts, both on the left, which is individual security, and on the right, which is individual country, there's just a lot more dispersion than there is in developed markets. You have to be careful about security misweights and country misweights. There's a lot more volatility associated with being a little bit overweight one stock or one country in the EM space than there is in the developed market space. So again, design matters when you think about factor investing in emerging markets. This slide really shows that it's not as easy as just sorting by quality or value or volatility and buying the top half. These things here will blow you up in the process if you did not take them into account. And then the last thing I'll say, and we'll open it up for Q&A, and this is a very important point, is we go to slide 10, the last slide. When we think about share issuance being the big drain in terms of performance over the last decade, there are ways to combat this. Now, if you just purely look at share issuance in and of itself, that's an okay way of sorting individual securities into kind of good and bad buckets. A much better construct is something known as composite equity issuance, which looks not only at share issuance, but also share buybacks and dividend yield. When you think about how do you return capital to equity shareholders, there's only a couple of ways of doing it. Buybacks, or bringing it in as issuance, or through dividend yield. When you bring all three of those things together in the emerging market space, that has been a fantastic predictor of return. So low composite equity issuance is the blue line at the top. You can see that cumulative performance versus high composite equity issuance, green line at the bottom. Note that green line hasn't changed in a decade. Performance of those stocks with high composite equity issuance, meaning high share issuance coupled with a low dividend yield, has been flat, where there has been value add for low composite equity issuance. This is one of our components of our quality factor, a very potent component of our quality factor. One more reason that when we think about investing in the emerging market space, factors have a lot to offer. Quality, because it combats some of that share issuance problem, has a tremendous amount to offer, not just in terms of return, but also in terms of risk, as a risk mitigator as well. All right, so EM, a lot to offer, good fundamentals, good valuations. How do we access it? Many of our clients accessing it through factor strategies that have added value over time, and certainly added value recently. Again, not just from a return perspective, but also from that risk mitigation perspective. But design matters. When you think about constructing that emerging market portfolio, you have to be very, very careful about how you implement, because there's a lot of risks out there in the EM space. We saw them this year, countries, stocks, sectors, etc., that can wreak a lot of havoc to your portfolio. All right, I'll end my comments there. Wouter, I'll turn it over to you. I know you've got a few questions already.
Excellent. Thank you very much for that, Mike. And once again, for the audience, if you would like to ask a question, please type it in the question box and we'll get to it. So we have some questions already. Mike, you showed how important the drag was from share issuance on the performance of emerging market stocks. There's a question on the slide that you put up where you could sort of see the different bars with the gray representing the drag on performance. And the question is, if we would compare this to the US, would this gray area, would it reflect the strong buybacks that have been happening in the US?
Yes, slide 4, if you want to flip to it. But the short answer is yes, it would. So contrary or in contrast to emerging markets, developed markets, especially the US, has had a buyback. So you would actually have seen that above the line. Now, it's not nearly the magnitude that you see here, roughly about 1.5-ish% in total. And that's, recently been higher than it has been in the past. But yes, you would have seen that. In the US, that would have been a buyback instead of an issuance, and that would have been above the line instead of below the line.
Yeah. So share issuance has been a big drag. And how confident are you that this will become less of a problem going forward? Is there any indication that there will be less share issuance?
I really wish I could answer that question definitively. The only thing I can really say is that we don't see any impetus for this slowing down anytime soon. It took a while to get here in the EM space. This is not a trend that reverses immediately unless there's a regulatory impetus for that happening, and we don't see that on the horizon. So when we look out over the next decade, 10 years forward, we are absolutely factoring this dilution effect or the share issuance effect into our long-run return expectations.
Yeah, I think the optimism came from, we've seen in China especially, that there's been less issuance and even some share buybacks already in that market.
Yeah, don't get me wrong. I don't think we're going to see the magnitude that we see today, so the 10.9 that we saw over the last decade in China in particular. Our expectation going forward is about 6.5%. Now, I wish that was more scientific than it really is, but that's just more of a kind of a gut feel based off of coming off peak, if you will. But some of the other countries are actually ramping up. India, for example, has generally grown in its share issuance. So while one country may contract a little bit, others may start to expand their issuance efforts.
Yeah. So analysis by Northern Trust show that in the next sort of 3 to 5 years, there will be significantly higher earnings growth in some of the markets. And I think there was particular optimism about Taiwan, India, and Korea. Can you walk us through this?
Yeah, sure. And I think that's on slide 3 if you want to show that. So to some extent, there's sort of two things going on here at once. One is, to some extent, whatever China has to lose, other countries in the emerging markets have to gain. But that's not the main driving factor. That's part of it. It's part of the driving factor here. The other is that when you look at the earnings growth in really all countries across the world, not just in emerging markets, but developed markets as well, there is not a high correlation between GDP growth expectations, earnings growth expectations, and actual equity performance. Those relationships, while intuitive, are imperfect at best. And I would say that generally speaking, when you look historically, especially at GDP, which translates to earnings growth and its relationship to equity performance, it's almost zero what the long-term correlation has been. What is a much better predictor of GDP growth and therefore earnings growth in all markets is not better predictor of equity returns and earnings growth is not GDP, but the country's marginal product of capital, meaning that how efficiently can the country actually invest the capital and therefore generate returns, earnings growth, and therefore returns. And you can see that in the case of Korea and Taiwan in particular. The marginal product of capital, the efficiency with which they put an additional dollar of investment to work is very, very high. Where in contrast, China has come down materially over the last decade. 20 years ago, this number was double. The marginal product of capital was double. That has come down materially over the last decade. That is contributing to a little bit slower earnings growth. So there's a number of things going on under the hood, but Korea and Taiwan in particular, when you add an additional dollar of investment in the equity market, that marginal product is just so high, it translates directly into earnings growth, and our expectation is returns.
Yeah. There's a question here again relating to the share issuance. How persistent is share issuance at a company level in emerging markets? i.e., does a company that issues shares in 1 year, is it more likely to issue shares again the next year?
The answer is yes, but not forever. Now, we don't have a perfect data set here, so I can't tell you definitively one way or the other. This phenomenon has kind of built on itself over the years. Now, all that being said, there is a correlation between share issuance 1 year and share issuance the next year. Company by company, I would say it tends to go like in a 3 or 4 year cycle. But net across all of the companies within an individual space, it's just been a growing phenomenon. So yes, there is a difference. There is a cycle associated with it. It's not a perfect correlation, but it is certainly positive.
Yep. So if we delve a little bit into the factor framework, you sort of mentioned that if you have a fairly simplistic way of incorporating factors in emerging markets, it can lead to some significant unintended and uncompensated risks in the portfolio. What are some of the key risks here?
So idiosyncratic risk, which we highlighted, again, especially when you're dealing with concentrated markets, the almost inevitable outcome, if not controlled, is that you're going to underweight, again, the largest names in the benchmark, and therefore take on a lot of idiosyncratic risk in that process. You may not even realize that. So let's say that, in EM space, I'm underweighting, Taiwan Semiconductor or something like that, a very, very large stock, to get active share elsewhere in the portfolio, I am taking idiosyncratic risk as a result of that underweight. So more concentrated markets tend to naturally have more idiosyncratic risk in active portfolios unless it is specifically dealt with. Also, countries. When we look at the country dispersion, when I showed that in a previous slide, there's a lot more volatility, and we saw it this year. There is a very, very wide dispersion in individual country performance. What this means is that small misweights relative to the benchmark at a country level tend to have the potential for a lot of risk associated with it. Now, in general, and Wouter, you and I have talked about this on previous webinars, idiosyncratic risk, country risk, sector risk, if it's not intentional, tends to be uncompensated over the long run. So if I'm exposing my portfolios to all these sources of risk and not getting paid for it, that is not an efficient implementation. This is why design matters. How you put that portfolio together really matters.
Yeah, and one of the slides you showed that some factors, they work better in certain emerging markets as others, or they have higher performance, higher alpha. What is your view on putting all of this together? Do you sort of advocate an equal weighting of factors, or do you, and may I say, time factors in this sense?
Yeah, it's a great question. So I would say that even though empirically, historically, some factors may outperform others, it's really tough from a statistical perspective to make a conclusion, a definitive conclusion on the performance of one factor versus the other. Now, that's over the long term. Now, that being said, many of our clients choose to weight their multi-factor portfolios in a few different ways. One way is to look historically, but not at returns, but at risk, and think about implementations where you're going to weight the factors based off of either their marginal contribution to active risk. So of the total active risk pie, how much does the individual factor contribute, potentially equalizing those, or perhaps equalizing their marginal contribution to total risk, to say that when I look at the total risk pie, not just the active, but the total risk pie, I want an equal weight coming from each factor. That will mean that depending on where you're at in that volatility cycle, you're going to have a different weight to each factor. That is one or actually both of those are very popular approaches to building multi-factor portfolios. But more recently, we also have seen a lot of innovation, and we ourselves have published some really interesting research on this in collaboration with the University of Chicago professor Stefan Nagel. We recently put a paper out on SSRN about the potential of timing factors based off of macroeconomic as well as sentiment or momentum signals, not just momentum as a factor, but the momentum of the factor itself. That seems very, very promising. So if you are interested, go to SSRN and download that paper from Northern Trust and the University of Chicago. I think there's a really, really interesting innovations. A lot of it's centered around machine learning approaches or shrinkage approaches that can be extraordinarily effective in the emerging markets as well.
Shrinkage approaches? What are they?
Shrinkage, sorry. So it's sort of a machine learning term where instead of just weighting a portfolio based off of historical returns to say, okay, well, value outperformed momentum or momentum outperformed low volatility, instead of weighting a portfolio based off of those sort of naive estimates, if you will, naive just meaning, and I'm just going to take the historical version. Shrinkage basically is a Bayesian context, meaning that I'm not only going to take the historical return into account in making my estimate, but also the historical volatility of that factor. And when you think about shrinkage, basically what you do, and this is a very crude description, is that you take the, call it unconditional expected return, historical return, and shrink it or reduce it based off of its volatility. So the more volatility an individual factor has, the more shrinkage it has, the more we nick or reduce that return expectation based off of that risk. So again, a Bayesian approach, very much alive and well in the machine learning space. This is where we got this idea in the first place. But the whole intent is to make more robust portfolios. So at the end of the day, what you actually achieve going forward looks more like your return estimates that go into your model. Today, without any kind of shrinkage, that's never going to be the case.
Yeah. We might finish up with a question relating to macroeconomics and geopolitics. Emerging markets tend to be heavily influenced by the US economy, especially the strength of the US dollar. But we also got the US elections coming up very soon. Does this correlation show up when you're putting the factors together for the emerging markets? Does it show this influence of the US?
Yeah, absolutely it does. And there is a tremendous sensitivity to factor performance and interest rates as well as inflation. And obviously inflation and interest rates are themselves correlated when you look across the globe, but certainly between the emerging markets and the US in particular, whatever the monetary policy regime we're in the US. So, just simply put, the higher the rates, the higher the US dollar. Clearly in dollar terms, it's going to influence materially the performance. But even independent of that currency exposure, a declining interest rate environment, especially when you're coming off very high peaks, tends to be very, very good for factor performance. When you think about sensitivities, defensive securities, quality, low volatility tend to do quite well when interest rates are high and when they're transitioning into a different rate regime as rates are going down. We've seen that already in equity prices. It's very, very often the case that as you transition between monetary policy regimes, and remember, we had a very, very rapid increase in rates in the U.S. The expectation is for a more gradual decline in the U.S., but we got a 50 basis point rate reduction right out of the gate. That clearly caused a lot of volatility in U.S. equities and emerging market equities, but certainly benefits more defensive postures, higher quality, lower volatility in all spaces, EM and developed markets.
Yeah. And I'm afraid that's all we have time for today. So thank you very much to Michael Hunstead and Northern Trust Asset Management. A recording of this webinar will be available at a later stage and will be sent to our attendees. And with that, I would like to thank you and enjoy the rest of your day.